All right, welcome everybody. We're going to start on time today, and I appreciate you joining us here. We're going to talk about trading gold and silver. Thanks for joining our special presentation. And the recording, there is going to be a recording available as well. So if you miss anything, don't worry, we'll get that recording out to you. So I see people joining the room and other people have been waiting. So thanks for being here. We're going to start off here looking at this quote from Alan Greenspan. And he says, if gold is a relic of history, why do central banks plus the IMF still hold over 1 trillion of gold? If it's meaningless, why is everybody still holding it? So we're going to dive into a bit of that. And actually, in just over a year and a half or so, gold's up about $1,000 since he made that quote. And before we get started, take a look at the risk disclosure here. The important thing would be really the last sentence or two. All funds committed should be risk capital, and past performance is not a guarantee of future results. All right. And a little bit about AltaVest. Since 1997, we've been a registered introducing brokerage firm with the CFTC. We're members of the National Futures Association, and we're located in California. It's a picture here of yours truly, and then my business partner, Mike. You'll hear from him during the presentation, and another colleague of ours. And these two gentlemen here worked on the S&P 500 options trading pit, and they fulfilled all of our option orders over the years. So a little bit about myself. My name is Eric Gebhard. I'm a co-founder of AltaVest back in 1991. This is when I became licensed, and I have my BS in Business Administration from University of Southern California. And then I'll introduce Mike Armbruster. And Mike, maybe you want to introduce yourself here and tell everyone who you are.
Sure. Yeah, I'm the other co-founder and got licensed a couple of years after Eric did in 1993. And I got my degrees from University of Kansas. So go Jayhawks.
All right, very good. And I don't know, maybe you want to mention this here as well, Mike,
Sure.
this MarketWatch article.
Yeah, so the reporter over at MarketWatch just a couple of weeks ago, October 17, looks like, um, reached out to us and, their question was, hey, what do you guys think? Do you guys have where do you see a price ceiling for gold? And it's kind of funny question, I thought. And basically, our response is right here. And, gold, we really don't see a price ceiling anytime soon. Um, the basic point is the trend is up and the gold um, fundamentals are really unchanged. You know, one of the biggest factors is out of control federal spending, which ultimately debases the US dollar, drives inflation. And then separately, um, you've got foreign demand for gold, foreign central banks, and then you've got the BRICS countries that are committed to de-dollarizing their foreign reserves. So that also puts an extra bit of pressure on the dollar and is bullish for gold. So we'll go over
Okay.
these points in this presentation here, basically.
Yeah, absolutely. And I should point out too, you're free to use the chat there and ask questions and so forth along the way. We may not get to them right away, but we'll save some time at the end. And we're going to look at these key factors in the bull market here that's occurring in gold. Look at the ETF demand. Look at the U.S. budget deficit and the Fed and their monetary policy. Take a look at inflation. We'll jump into some of the central foreign banks and what they're doing. As Alan Greenspan mentioned, it's not only central foreign banks, or foreign banks, as I should say, and then also the BRICS. We'll talk a bit about that. And then here is a graph here. Mike, you want to jump into this graph?
Sure. And it's interesting if you look back over the last 20 years and you compare gold, which is the yellow line, to the S&P 500, which is the blue line, and then the orange line is the Russell 2000. You can see, and this is actually a little bit out of date. Gold's actually up a little further, up another 50 bucks or so since we made this slide, and I think the S&P is roughly the same, maybe a little bit lower. But gold over the last 20 years has outperformed the S&P 500. It's up, 6.5 times, and the S&P 500 is up about 5.3 times. So not something that most people really don't really focus on the gold market, but most people are very aware of what the S&P 500 is doing. So
Right. So basically, it's been your best performing asset class versus what's on the screen here. Of course, if you were in, Nvidia and sat on it, you'd be outperforming. But nonetheless, gold has been under the radar, even though it's been outperforming. So it's sort of an interesting dynamic. And you want to jump into the ETFs here?
sure. So the rally in gold. Most of the physical demand has been coming from Asia and really has not been coming from Western investors. Um, and it's interesting. So what you're seeing on this chart that Zero Hedge put out is the black line is gold ETF holdings, and the blue line is just the price of gold. So you can see for a while they track, pretty closely. And then right about late 2022, right about the time that the S&P 500 bottomed, the Nasdaq bottomed, we had that big kind of bear market in 2022. Everything started moving higher, yet interest in gold actually continued to drop. And I think, when you think about what was going on at the time with Nvidia going straight up and everybody, looking at the large cap tech stocks, that's just where investor interest was really focused on those types of companies and in this equity markets. So gold really didn't get any traction from investor demand, and even though the price was going higher.
Right.
So, so the point that Fred Hickey here makes in his tweet is that, at some point, Western investors are likely to start rebuilding their positions, and that is a bullish factor for gold that could still come into play to drive prices even further higher. So, and then here's Jim Rickards, and this tweet just came out today. So he, pointed out we finished at 27.85, new all-time high for gold. Who's buying? Well, central banks, BRICS countries, billionaires, of course. Who's not buying? He says everyday Americans yet. So kind of
Right.
making the same point. Although, we have seen stories in the press, Costco selling some small little, what are they, 1 ounce bars, Eric?
Yeah.
They've been
I think
selling it. Yeah, they can't keep
little
them
small
fast enough. They
bars.
just, yeah, they've been really, going crazy. So I guess to a certain extent, Americans are interested in gold, but in terms of getting involved in a more formal investment position, that's not the case quite yet.
Right. And then how about now we're starting to see some movement here into gold funds here.
Right. So this tweet was just yesterday, and they were talking about the prior week. Um, Looks like a chart from Bank of America Global Research, and really large inflows into gold funds. So it's definitely investors are starting to notice
Yeah,
for
they've been
sure.
looking the other direction and now they're starting to wake up.
Right.
Okay, how about we'll look at federal spending and what the Fed is doing. Economist
Yep.
Lynn Alden talking about
Yeah.
nothing stopping this train. So here's a graph you can walk us through.
Yeah. So what this is showing, and we got this from Hedgeye, something they put out in the public, and they talk in the green shaded area. This is the period 1962 up to the financial crisis in 2008. Basically, you had a pretty stable debt to GDP ratio in the U.S. And then things really phase two, the gray bars, is when um, really our Federal Reserve started with the real money printing. That's when things really um, changed, and with all the bailouts, the TARPs, and so on and so forth, and the easy money, really kind of Ben Bernanke's era forward, um, putting us to the where the yellow bar is now. This is, estimating about a 97% debt to GDP ratio, basically around 100%. but based on CBO, Congressional Budget Office projections, um, the out years are looking kind of scary. You've got debt to GDP ratio going from 97% to 172%. This is based on the laws that are currently on the books. It's assuming no war and no recession, which, those are some unlikely
Right.
expectations. So, um, the outlook,
Government spending, yeah,
yeah,
so government spending is not slowing down, it's speeding up
right, right.
in relation to GDP.
Unless there's something dramatic that changes, yes.
Right. And Lynn Alden here
So,
says,
yeah,
yeah, go
go
ahead.
ahead, Eric.
Well, I was saying, and Lynn Alden here is just saying, kind of stating the obvious. This is what happens when public debt reaches well over 100% of GDP, financial repression, and currency or debt devaluation versus scarcer assets. Happened in the 40s. It's happening again. And here's just another graph and another way to look at in this case, the deficits. So if you want to take a look at this one, Mike, real quick.
Yeah, so this is basically, you can see how the deficits have been growing every year and just basically trending, um, you know, in the wrong direction. The big one, negative $4 trillion deficit down there, that's the COVID pandemic, when basically the economy got shut down, and the government just gave out a bunch
Right.
of checks. We've rebounded, and now we're around 2 trillion a year. Uh, that last chart that you had didn't include the fiscal year that just closed, and that's what the next slide is pointing out, that it was ended up around 1.8 trillion for fiscal year 2024. So, still around that negative $2 trillion mark. And this is at a time when, you know, supposedly the economy is strong,
Right.
and so on.
Here's a
And
bigger
then,
picture here.
yeah, and just in this month of October, the first 3 weeks of October, of course, we're coming into an election, but the national debt went up by $500 billion in the first 3 weeks. So pretty dramatic. Um, I suppose, the current administration trying to keep things looking as good as possible heading into the election.
Okay,
And
here's a
then,
slide on, oh yeah, I would say foreign U.S. Treasury holdings declining quite a bit here. So you want to walk us through this one?
sure. So the peak in terms of the percentage that foreigners owned of U.S. Treasury debt peaked in 2008 at the financial crisis at 33%. That has now declined to 22% of the total. Now, it doesn't necessarily mean that they own less nominally. They probably own pretty close to what they owned before in terms of total, dollar amounts. But it's just that our deficits have gone up so much that their percentage has come down. We're issuing so much debt, they can't keep up, to maintain their 33% or to grow it like they were for so long. Um,
Right, they're drinking
we
from
do,
a fire hose.
yeah, and also, China has been selling their treasury debt. So, that is one country that has been reducing their exposure to our debt.
Right. And well,
And
who
so
has been buying all the debt? That's the question. So
that
here's
is
the
the
answer.
question. There you have it. The Federal Reserve is the buyer of last resort.
So they're the lender and buyer of last resort.
Yep. And so here is a quote, Rudy Havenstein is quoting Mike Taylor. And basically, the upshot of this is that all you know, the Fed meetings and the rate hikes or cuts and this and that, is really all kabuki theater. And really, when it really boils down, the Fed's job is, at the end of the day, is to make the U.S. Treasury look solvent. Because if the Fed or the the Congress authorizes a bunch of spending, really the Fed has no choice but to ultimately print money to finance that debt.
Yeah, they have to accommodate them, or else you have a real problem in the U.S. debt market.
Right. So here's an interesting, earlier, a few weeks ago, Stan Druckenmiller, probably the greatest investor of our time, I don't know, Eric, what did he make? Like 30% for about 30 years in a row or
Yeah,
something like that.
with no drawdowns.
Yeah. uh, he basically went short treasury bonds when the Fed cut rates 50 basis points at the last Fed meeting. And he put in 20% of his entire portfolio into that position. So, um, bonds have been going straight down ever since. And so, he's basically saying, okay, Fed, you're going to be cutting rates. That's going to fan inflation. Bonds are not likely to do well. They're going to, investors are going to require a higher return if you've got an inflationary environment going forward. So,
Right. And then here's another famous investor, and
yep,
look what he's invested in there in the yellow highlight.
yep. Paul Tudor Jones, famous guy just last week on CNBC being interviewed. Basically, you can read it right there. All roads lead to inflation. He's long gold. He's long Bitcoin, which I think today was close to a new all-time high as well.
And gold.
Owns zero fixed income. And basically, the playbook to get out of the debt problem is to inflate our way out. That's
Right. So
his,
basically creating money and essentially inflating the money supply, which inflates consumer prices. A
yeah.
bit of both
And,
there. So here
and
we
he
go.
also makes the point that he's also going to be going short treasuries after the election. So,
Right. So
um,
speaking of inflation, that's point number 3 here. So there's a good quote. I'll just read that. It says, inflation is made in Washington because only Washington can create money. What produces it is too much government spending and too much government creation of money and nothing else. So from famous economist Milton Friedman. So here's a graph we can look at. This is inflation adjusted performance on the price of, looks like the shadow stats alternative here, inflation adjusted for gold. So you want to look at that one real quick, Mike?
yeah, so the gold line, the yellow line is gold, and the shadow stats alternative CPI estimate really fits the gold price quite well.
Oh
And then you
yeah,
have the red line down at the bottom is the official CPI number that the government puts out, which is, you know, many would argue, engineered to not move that much, even though we have seen recently some, 9% inflation, CPI inflation, which was probably basically um, the
half of
shadow
what it
stats
really
numbers
was.
probably, yeah, probably half, probably a lot
Right.
worse.
Okay. Here's an interesting chart, sort of an analog looking at history.
Yep.
What does this
So,
tell us?
and this is the CPI. So the red line is back in the 70s when we had the inflation wave. Um, and then the blue line is what we've recently experienced. So in 2022, when the official rate got to 9%, it's recently come down. What's interesting is, some of the projections are expecting that we are just now probably, bottoming, not quite getting to the Fed's 2% inflation target, and it's likely. I know Hedgeye has an estimate that that we're likely to see inflation get back over 3% sometime in the first quarter of next year. With the Fed cutting rates, that's not going to be helpful for the inflation fight either. So.
Right. So we might end up in a similar scenario here where history sort of in the current present situation rhymes with history as we're sort of bottoming and missing the mark on stamping out inflation. So we'll see what happens, but sometimes history does rhyme. And you mentioned the Fed has a 2% inflation target. So
Yes. So I think we've all this meme that Ben Hunt put out. Uh, we've all kind of seen the Fed talk about how they want, when inflation went over 2%, how they want, they're very steadfast in their commitment to getting inflation down to 2%, and then, it slowly morphed their message as it wasn't coming down fast enough, and they just said, well, it's going to get down over time. And um, then it's more of, well, you know, that's, kind of an aspirational target. And it kind of feels like we're somewhere between step three and step four. And if we
Yeah.
get a real reacceleration in inflation, um, the Fed's in a tough spot. So we'll see. But
Yep.
the
Yep.
meme fits. So,
Yes.
the way the Fed, prints money, and you probably already know this, but is when it buys U.S. Treasury securities with dollars it creates out of thin air. This increases the money supply, M2, which debases the purchasing power of the US dollar. So, you create more dollars and simply they're worth less. And here's a good picture from the Visual Capitalist and showing that the US dollar has lost 96% of its value from 1913 to 2020. And actually, since 2020, it's lost another 18% since then.
Right.
So,
So don't put cash under your mattress.
right.
That's and then here a bit about foreign central banks and how they're
Yeah.
approaching gold.
Yeah. So, pretty interesting chart. For a while back, before the financial crisis, gold was really out of favor. You had central banks, were thinking, why are we holding this asset that's not doing anything? I think, Eric, when we started AltaVest back in 1997, gold was back and, was down in the 200s. I think the Bank of
Oh yeah.
England was selling their gold and, it was just, nobody wanted to be involved with it. But after the financial crisis hit, central banks have been net buyers every year, led by China and Russia, Russian central banks. Um, lately they probably have an even greater incentive to buy gold with, the way the U.S. has been blowing its deficits up. China is also a money printer as well. So, who knows what they have in mind in the future, but they're
Right.
definitely accumulating physical gold.
Right. Well, also, Russia was sanctioned, of course, economically, and so that it's kind of making a lot of people think about sort of removing themselves from holding dollars and treasuries, kind of
Yep.
like which is what's occurring here with the BRICS. The BRICS economy is starting to formulate here as we speak, kind of living through history here. They just had a meeting. This was from earlier this month in Moscow, but they had another meeting in, was it Kazakhstan or
I
Kazakhstan
think it
last
was
week?
a place called Kazan in
Kazan,
southwestern. Yeah, I've never heard of it,
yeah.
but somewhere in Russia. Um,
But so
yep.
yeah, look at these bullet points here if you want to run through those real quick. But there's really nothing to elaborate too much on those. I think they're kind of self-evident as to what
Yeah,
what they're
I
doing.
think the whole idea is they're trying to get away from the dollar, uh, and I think you mentioned it before to avoid, the power of U.S. sanctions. So they're, de-dollarizing their foreign currency reserves, and that's going to, that feeds back into if when they hold dollars in their foreign currency reserves, it's not just dollars sitting there. They put that into a dollar asset like treasuries. So if they're de-dollarizing, that means they're getting rid of their treasuries, and so that we have fewer buyers for our debt as well. So just kind of fans the problems of
Right.
demand for our debt.
Okay. And then a couple other bullet points here to
Yeah,
summarize gold.
yeah. So gold ETFs and those types of investor demand in the West has yet to emerge, but it's likely. Or whether it's ETFs or futures like what we do, um, that is something that all indications are in the recent weeks it's starting to pick up. And who knows what's going to happen with the election. But budget deficits are likely to grow. We did see Elon Musk, if a Trump administration were to take over, he's claiming that he could cut 2 trillion in spending. So that would be, quite something if he was able to get that done. But, barring dramatic spending cuts and, generating some higher revenues from, whatever source, whether it's taxation or uh, the tariffs or possibly, drilling for more oil, you name it. There are a lot of ideas out there. Um, the deficits are likely to continue to grow. And
Right.
then as they grow, the Federal Reserve will continue be forced to really to monetize that debt, and that's bullish for gold.
Right.
And of
So
course, central
that
banks.
yeah, go ahead.
Yeah, yeah. I was just gonna say, the debt monetization, foreign central banks, the trends are they're still buying gold, um, and of course the BRICS countries that we've mentioned de-dollarizing.
Right. Okay, so that summarizes a bit about gold, but that also has an impact on silver. So we don't want to totally forget about silver, although central banks don't necessarily find silver as appealing as gold for various reasons. But nonetheless, sometimes that rising tide can lift various boats. But here's an interesting chart and the gold silver ratio back to 1975. And uh, what's the take on this one here, real briefly?
Yeah, here's we got this chart from Hedgeye as well. Um, Historically the extremes on the gold silver ratio are 14 to 126, but those are some real outlier events on those extremes, and the typical range is between 40 and 90. Recently it hit 90. The average is about 62, and it's currently just over 80. Um, Eric Larkin was interviewed by Hedgeye, and he noted that in recent years, when the gold silver ratio has hit 90, meaning that silver is undervalued relative to gold, um, that silver tends to rally about 35% over the next 6 months. That was, you know, silver would have been right around $30 when that would have happened recently. So, that suggests that we could certainly get over $40 um, if that tendency were to reoccur again. And you can see the monthly chart here. If you're a technician, you might see some bullish patterns here, cup and handles and so on. You get the prior high is up around a little over $48. So even $40 would not be a new all-time high, but when silver moves, it really goes at times. So it's
Right.
something that you can consider including in your mix along with a long position in gold.
Okay, so look at the volatility now compared to gold and silver. So let's take a look at a couple of these graphs here. Um, and this one here is Bitcoin. We'll start with that. Notice how, I guess the idea on this chart is to represent how volatile prices can be.
Yes, so Bitcoin, a lot of people think, oh, it's an alternative currency. It's really more like a commodity. It has when you look at volatility characteristics of a various asset class, uh, Bitcoin is not a currency. It is an extremely volatile, more commodity. A 78% drawdown from November of 21 to
Here to
November of
here.
2022.
Yeah.
That's pretty extreme.
Okay.
But
And how
but
does
it
that
is but it
compare?
is but it is back near a new all-time high. But
Right.
it was a pretty wild ride to get there.
Right. For sure. It's definitely tracking gold right now and the Nasdaq in some weird way. Um, and here's the 10-year Treasury notes and compare the
Yep.
volatility there. And these notes have been moving quite a bit, kind of out of character too.
Yes. And this is basically what Druckenmiller and Paul Tudor Jones are shorting. You got the 10-year notes down 22% since the pandemic peak. And then I think on the next slide, you've got the 30-year Treasury
Right.
down even
Similar
worse. Just
theme there.
Yeah, if you were
Yeah, down
unlucky enough to
40%.
buy at the peak, just in terms of the price that you're holding, what you paid for that bond, you're down 40%.
Right.
Um,
And then just to clarify too, the price of bonds is inverse to the yield. So if you're expecting, higher rates in the future, then the price of the asset or the bonds and the notes is going to decline. So that's what's happening here. This is interesting too, looking at gold versus the what's the 20-year yield? I believe that is.
yeah, I think that's a 20 or 30-year yield, basically a long dated yield on the treasury. And typically, in a normal environment, if yields on the treasuries, long dated treasuries, are going down, that tends to be bullish for gold. So, gold competes for dollars, investment dollars, and it doesn't pay interest, it doesn't pay a return. So, as rates fall in treasuries, they become less competitive with gold, bullish for gold. But what's interesting lately is that as rates have started going back up again, gold has just totally shrugged it off and continued to trek higher. And I think the explanation behind that is really it's foreign demand. The central banks abroad buying physical gold and accumulating gold is really what's been the
Hmm.
key driver for gold.
Okay, and then
Here's,
jumping to silver, looking at the volatility on silver.
yep. Now, silver is definitely also a commodity, a big 42% drawdown from February of 21 to September of 22.
Hmm.
And gold and silver, you always think of gold and silver as, moving in lockstep, but they really don't. Uh, Silver is much more of a base metal. It's a commodity, um, and in different economic conditions, it will. Um, there are some conditions where it will actually be quite bearish, while gold is bullish. So, in a deflationary example, for example.
Yeah, and here's a look at gold. You can see how much less volatile it is compared to something like Bitcoin in particular.
Yep.
Only down 22% versus what, 78% at its worst.
Yeah, and this chart, we chose the peak to valley on trying to, highlight what the percentage on the drawdown, but actually that prior chart on silver, that drawdown started earlier, so you can see for a few months starting in February 21, silver started dropping. So if you go to the next chart, gold didn't start dropping, didn't it was actually going higher all the way up until March of
Hmm.
2022. So, and then it started coming down and had a drawdown. So there's definitely times when they're moving in different directions.
Right.
But yeah. And so
Here's, yeah,
good,
yeah, go ahead.
yeah. Oh, I was just going to say good old Alan Greenspan has a good quote. Yes, gold is a good investment. Remember, gold is a currency. It is still, by all evidence, the premier currency. No fiat currency, including the dollar, can match it.
Yeah, I
So,
think I think what he's saying there is really summarized in these charts, because typically a currency is not going to be nearly as volatile as an asset or any other asset or speculative instrument. So you can see it here in these charts. The difference in the
right.
volatility in gold definitely has the least amount. So we'll look at some gold and silver futures contracts and look at some of the details and what the specifications are. We'll first look here at gold. So there's micro gold, there's COMEX gold futures, and we'll look at that. Mike, you want to run us through that real quick?
Sure. So you might be thinking to yourself, okay, I, how would it look? How would I get involved? So, the minimum that we would recommend if you wanted to have a long position in gold in this market would be $10,000 in an account, commodity account. And so what you could do with $10,000 is you would be able to purchase a micro gold futures contract. The margin is roughly $1,100. That may have gone up just slightly recently, but less than, it's about 11% of your account is in margin. Generally speaking, when I'm talking to our current clients that have long gold positions, and we've been doing this with our clients since for over 20 years, um, you know, we'll always try to keep the margin below, 15%. Maybe there's times when for some, for one reason or another, they want to be a little more aggressive, and other times when they want to cut it back a lot more. But if you look at what you're controlling, with gold at this time, when I made the slide, it was $2,700 an ounce roughly. It's up even more since then. So you're at $2,700, 10 ounces, you're controlling with $10,000, $27,000 worth of gold. So you have 2.7 times leverage versus if you were to buy, say, a gold ETF, which would just be one-to-one leverage. If you wanted to deleverage this type of position, you would just have more money in the account. So you could go $27,000 for one micro contract, and that would be 1-to-1 leverage. Um, so if you're ultra conservative, but if you want to add a little leverage, that's you get the idea. And likewise, there's 100-ounce contracts, so you would need a larger account for that, and margin of $12,100 per contract. So you're going to want at least $100,000 to control $270,000 worth of gold.
Right. And I think one of the key things to note about the micro gold and the COMEX gold contract would be essentially every dollar that gold moves, if you have a micro contract, it's going to be worth $10 for or against you. And if you have a COMEX gold futures contract, every dollar gold moves up or down, that represents a $100 move for
Yeah.
that
So,
contract.
for example, gold was up $25 today. And silver was up 44 cents.
Yeah, so if you had a micro gold and it was up $25, the price of gold, that'd be a $250 difference in your account, or a $2,500 difference if you have a COMEX gold. So just to
Yep.
clarify that. And then here's silver,
Yep.
similar, but just different numbers.
Yeah. So if you're in the right setup and where you want to add some silver, it's the same idea. Depending on the size of your account, you could add a micro contract or a regular COMEX contract in addition to your gold position. We probably wouldn't want to be exclusively in silver. It is much more volatile, but it is something that you could add to a gold position.
Right. And also we do trade options as well, but we don't want to spend the time getting into that right now, but certainly you can reach out to us and we can tell you about more about the futures contracts and how to trade those, but also we do trade options as well. And some of the benefits to trading with futures and futures options. Uh, Go ahead, Mike.
Oh yeah. So they are tax efficient. So you get your gains and losses get 60/40 treatment. So um, if you have a gain, 60% is a long-term capital gain. So you get the lower um, tax rate, which is I believe around 20% versus your normal income tax rate. And so that's definitely a tax advantage. And then you don't have to itemize each trade. You just get a 1099 with your profit or loss at the end of the year.
Right? Very convenient. There's none of those, itemizing for what do they call it, wash sales and all that stuff you do with equity. So we don't
Yeah.
we don't do any of that. Um, in terms of a trading account, any kind of trading account like you would have at any other brokerage firm, we work with all those types of accounts, the IRAs, corporate, individual, trust, joint account. Individual accounts are sometimes can be turned around in a day. IRA or corporate or something like that may take longer to uh, get that account number. But
And if you are an existing client and are, one of our option traders, and you wanted to have, exposure to gold, if you wanted to do it with futures, that's a real simple process as well to just have a related account.
okay, so you see the link here. In terms of getting started, reaching out to us, we've got a page set up for you, cf.altivest.com/gold. This is our phone number. This is our email. You can take a screenshot of this. Reach out to us anytime. We'd be glad to walk you through any of the content here or just discuss your personal situation. One thing I do get questions on all the time, and I know we have a lot of people from overseas attending these events, and unfortunately, if you're in the EU, we can't work with you. It's not because we don't want to. Um, that's just the way the regulatory environment is, or Canada as well. So sorry about that, but thanks for asking. I know people ask that all the time. And we talked about the minimum account size to be able to do this with some room for error or margin for error in your account. So that's a $10,000 account. And what other questions? Let's see if there's any other comments or questions I can get to here. Well, one thing we mentioned it briefly earlier is what is the price target on gold, and I think that's sort of looking at it the wrong way. I think you just want to be, from our perspective, long that market while the current environment and the current landscape exists the way it does, and you just kind of work within the environment that you have. And if that shifts at some point, then we can change our position. But really, um, in the last 20 years or so, gold's gone up 10 times. So
Yeah,
who's to say
and the
it can't go up
clients,
another
yeah,
10 times?
I was just going to say, Eric, that the clients that we've been working with literally over the last 20 years who've been long gold or silver or a combination thereof, um, we have at times, uh, when the conditions are right, been more heavily long, and then when the conditions were not as good, definitely have pared back our long exposure as well. So um, it's not always full throttle, that's for sure.
Right. Okay. Well, very good. I think that's going to wrap it up. And again, reach out to us with that information on your screen and let us know what we can do for you. And we'll be glad to chat at your convenience. So thanks for joining us and have a great afternoon.